In the fifth and sixth modules of the course section devoted to consolidation workings, we turn our attention to the adjustments and workings required in order to prepare a consolidated statement of comprehensive income, and in particular, the consolidated income statement. The aim of the consolidated statement of comprehensive income is to show the gains or losses generated by the group over an accounting period as if that group were a single economic entity. In light of this, the method of producing a consolidated income statement involves taking the following steps: adding all items of income and expenses of the subsidiary to those of the parent entity, eliminating the effects of intra-group trading, typically by making adjustments to consolidated sales revenue and cost of sales, adjusting consolidated finance income and expenses for the effects of intra-group loans and borrowings, eliminating the P&L impact of dividends received by the parent from its involvement with subsidiaries. At the end of the day, the only dividend income to be shown in the consolidated income statement is that arising on the group's involvement in entities other than its subsidiaries and associates. And finally, apportioning the consolidated profit or loss for the year between shareholders of the parent entity and non-controlling interest. Let us now examine a comprehensive example which addresses many of the points listed above. Assume that P acquired 75% of the share capital of S on the 1st of January 2017. The income statements of the two entities for the year ended 31st of December 2017 are as follows. Additionally, let us assume that during the course of the year, P sold goods to S for €8,000, which included €2,000 of profit, and that S has already sold all of these goods to customers outside of the group by year end. The effects of the intra-group sale must be eliminated from the revenue and cost of sales lines within the consolidated income statement. This, however, is not necessarily the most intuitive of adjustments, so let's break the situation down into its individual components. P sold goods to S for a price of €8,000 and with a profit of €2,000, implying that P's cost of sales associated with the transaction equaled €6,000. We may think of this figure as the price for which P purchased the relevant goods from a supplier or the cost at which those goods were actually produced by P. At a later date, S sold these goods on to clients who are outside of the group. We do not know the revenue realized on this transaction, nor do we know the profit that was generated. We do, however, know that from the perspective of S, the cost of sales associated with this transaction must have been €8,000, seeing as this was the price which S paid for the goods. From the perspective of preparing the consolidated income statement, we only care about the price at which these goods entered the group, and that's the €6,000 of P's cost of sales, and the revenue from the sale of these goods by S to customers outside of the group. We must therefore eliminate, by means of relevant adjustments, the €8,000 of revenue arising on the sale from P to S, and another €8,000 of cost of sales from the sale by S to customers outside of the group. This produces revenue of $24,500 plus $15,600 less $8,000 to give an adjusted total of €32,100. Similarly, consolidated cost of sales is computed as $14,000 plus $10,000 less $8,000, giving a total of €16,000. The dividend from the subsidiary naturally gets eliminated in full, resulting in a consolidated profit before tax of €16,100. Adding the two lots of income tax expense produces a charge of €6,600, and so the consolidated income statement culminates with a profit of €9,500. You should appreciate that this is equal to the sum of the profits reported by P and S in their individual income statements, adjusted downward for the intra-group dividend received by P. The consolidated profit after tax must now be apportioned between the shareholders of the parent and non-controlling interests. Because the goods which were the subject of the intra-group transaction have now been sold on to outside customers, the €2,000 profit which was initially made by P has, from a group perspective, been fully realized and does not require any elimination. The profit attributable to shareholders of the parent entity is therefore equal to the €5,500 of P's earnings, adjusted for the dividend from the subsidiary, and 75% of the €4,000 of S's profits, which produces a total of €8,500. The profit which gets attributed to the minority interest in S is equal to 25% of S's €4,000 after-tax profit, giving a result of €1,000. Let us now explore a different version of the same scenario, this time assuming that the goods, which had been sold to S by P, still remain in P's inventory as at the year end. Because the €2,000 of profit on the intra-group transaction, which is reported in the income statement of P, remains unrealized, it must be eliminated by adjusting consolidated revenue downwards by €8,000 and the consolidated cost of sales by €6,000 in the same direction. These adjustments result in a consolidated revenue figure of €32,100 and cost of sales of €18,000. The dividend from the subsidiary gets eliminated in its entirety, leaving a profit before tax of €14,100. The consolidated income tax expense stays at €6,600, producing a net profit of €7,500. You should appreciate that this figure is lower by €2,000 than the after-tax profit computed under the previous scenario. Because the unrealized profit was eliminated from the income statement of P, the portion of consolidated earnings that are attributable to the shareholders of the parent will drop by €2,000 as compared to the previous scenario, producing a result of €6,500. The amount of profit which gets attributed to non-controlling interest stays at the same €1,000. In a final twist of the same scenario, let us assume that the intra-group sale of goods was actually performed by S, with P being the buyer, and that, as at the end of 2017, those goods still remain in P's inventory. In this situation, the required income statement adjustments would follow precisely the same logic as under the previous scenario. Consolidated revenue would be adjusted downwards by €8,000, cost of sales by €6,000. The dividend from the subsidiary would once again be eliminated in full. These adjustments would lead us to compute the same consolidated after-tax profit as before. This time, however, because the unrealized profit would have been generated in the individual income statement of S, the portion of net profit that is attributable to non-controlling interest would drop to 25% of 4,000 less 2,000, that is 500. The amount attributed to the shareholders of the parent would be given as the total of the parent's net profit adjusted for the dividend, and that's €5,500 plus 75% of the subsidiary's net profit adjusted for the unrealized element of 2,000, giving another €1,500 and €7,000 in total.